because to map the next step, which is, strategy and structuring, you have to look at the goal. Structuring, trust, companies, all of those guidance can be given by an accountant and or a buyer's agent only on the back of the amount of wealth that you want to build, right? So that goes back to the goal. So it starts with the clarity of goal, then goes into the second step, which is strategic structuring. And that's where an accountant such as Yuvraj and his team comes really, really handy. And key part of the team when you're building a portfolio is that accountant, because if you don't get that advice right at the start, you might get locked out of your borrowing and or would have bought a property in a wrong structure. As an example, I was talking to a build and press inspector. I think it was about 2 or 3 months back. He conducted a build and press inspection for one of our clients, and then he shared a personal story, which was that he bought a property in New South Wales and in the wrong structure, and he ended up paying $5,000 land tax. He had no clue. The way his trust deed was written would end up meaning a penalty of $5,000 for him, and then he had to get the trust deed changed for next year, but had to cop that penalty, and that's a big amount, a big negative cash flow. Yes, it's tax deductible and whatnot, but still a big amount that he had to pay from his pocket, and it wasn't a great experience. So strategic structuring is absolutely key. Planning the acquisition, which is forming the strategy. Where would you buy? When would you buy? At what price would you buy? Is then the next step, or sort of part two and three sort of go hand in hand. And then precise implementation and taking action is absolutely key as well. And taking action is usually very underrated and probably one of the most important things that we need to keep in mind while building a portfolio. So goal is great, strategy is great, mindset and structuring is, all of that is great. But if at any stage you forget to take action or life gets busy, all of that planning, all of that strategizing was for nothing. So having a goal is as important as it is to take action.
Yeah, just
Any
want to add on to that as well. Like, as you rightly said, yeah, action is the key. Yeah, procrastination is the biggest killer. When you keep on thinking, oh, I want to buy this property, maybe the prices are too high, the market is not right, the interest rates are too high. See, even if you like look at the data from 10, 20 years, even we had the days when the interest rate were around 18 to 20% as well, and people were buying as well. So again, it's all about getting in, taking the action, and the results will come if you put in the efforts, and consistency is there, then definitely, yeah, you will see that you've done or made the right decision.
Yeah, we've seen, I think, hundreds of investors make a lot of gains over the last few years when the interest rates were rising. So rightly said, you Raj, doesn't matter whether the interest rates are rising, are at a plateau or going down. There are always markets within Australia where money can be made as far as we're timing those markets right. So who would be presenting today? I think a lot of people here might know Yuvraj and I. I'll let Yuvraj kick off by giving an introduction, and then I'll give a small introduction for myself too.
Yeah. So hello everyone. My name is Yuvraj Verma. I run an accounting practice, Clear Tax Accountants, with my another business partner, Ash, and we specialize in terms of advising clients how to structure for property, and we do a lot of advisory in that area in terms of how will it pan out in the future, and the strategies are always not just a cookie cutter approach. They are based on what are the goals, what are you trying to achieve, and based on that, we'll advise you, to how to structure your portfolio so you get the maximized result in terms of as the topic of today's talk, in terms of reducing your tax and maximizing your borrowing, because you don't want to be bottlenecking yourself at a point in time where you can say, oh, how do I get to the third property now? If the structure is right, you got the right advice, then definitely you can become unstoppable. Thank you. I'll let you, Sudh, tell a bit about
Yes,
yourself as well. Yeah.
thanks, Yuvraj. I am Sudh, and I moved to Australia with my family in 2016, and we've been able to build a decent sized portfolio ourselves. In Australia, we love property. We are very passionate about property and renovations and whatever we can talk property for days and days. We never get bored. And this passion is what drove us to kick off. So Dish and I started this buyer's agency, FutureX, a year back, and we've helped about 60 clients over the last 1 year and helped them build portfolios. Most of the clients have bought 2 or 3 properties already, and we are on a mission to help 100 families retire by 2040. So that's really our mission in starting FutureX, and that's why structuring plays a very, very important part. We can't help people retire if they don't structure their loans right, if they don't structure their properties right. And that's why I wanted to invite you, Raj, who has helped a lot of our clients already, and we would love for him to help others as well on the journey. Our clients or not, whoever is even planning to buy themselves or through other buyers agents, feel free to reach out to you, Raj, because I think their team is really, really good and delivers with speed.
Thank you, Sudh. Right. So a little bit introduction about clear tax accountants. So I mean, see, when you go and look for properties, it's not just about just buying the property. It's more about, how to structure it. Because see, when you want to reach a goal, there's various ways you want to, you can utilize. For example, if you want to reach any destination, there are various vehicles available. For example, you can walk to your destination, or maybe you can use a car, or maybe can travel in a plane as well. So with different aspects, you achieve very different results. If you use a plane, you're going to reach your destination very quickly. And yeah, you might have pay a little bit cost, but again, depends what you're trying to achieve out of it. So again, structuring right will help you with the two most important aspects of the property in terms of making sure the borrowing capacity is there, and then utilization of taxes, which means you are in the right way to reduce your taxes wherever possible. And it's a smarter financial decision to choose the right structure in order to build your long-term wealth. And in terms of our name as well, clear, it's not about just the name, it's about how we work. Basically, it's about giving the right advice, clarity in taxes, and the clarity in advice. So proudly we are supporting 4,400 clients across Australia, and we got 75 people, professionals working with us throughout Melbourne, Sydney, and Adelaide. Right. So what makes us different? Yeah, again, it's about giving a transparency to the clients. Yeah, understanding their situation, problem, and giving a solution to them. So that's what we focus on. And in terms of what we do, we provide structuring advice in terms of SMSF, or whether it's an individual wants to reduce their taxes through PAYG variations and all, or people want to protect their assets and improve their cash flows. So we do provide advice, either investors and the business owners as well. So we can move to the next one. Yeah.
Thanks, Yuvraj. So a little bit about FutureX. So we have got about 10 years of experience of investing in property here. And that experience is what we now use to help people build their portfolios. Over the last 1 year, we've been able to build a portfolio of about $35 million for our clients. And they've already seen an upside of about $4 million gains just in that 1 year. This number, I wouldn't take that lightly, because, for us, it's very important. And I'm very grateful to be part of the journey of these people who have been able to make money through us. And it's only a start. That's year one gains. We are looking forward for these people to make a lot of money through property, because that's really the mission, to help them have freedom of choice. And freedom of choice, again, people don't take action for that. We get really stuck in jobs. Life gets busy. There are kids, there are tuition classes, there's swimming, there is soccer and whatnot. And whenever it comes to taking action, we always leave property right at the end. I did the same mistake. I wish I had a bigger portfolio back in 2018, 2019, rather than, scaling that through 2022, 2023. So I know exactly how it feels in hindsight. If this is something you can realize today and take action through us or through your own journey, I would be grateful either way. ROI for our clients has been more than 100%, so cash on cash return within the first 12 months. That is because those markets outperform. Mostly they are either about to get hot markets or hot markets that we buy in. We like to catch earlier after markets. That's always the goal. But sometimes we do buy in hot markets as well, because that is what the strategy dictates for that particular client. So I would take you through a couple of examples of some families that we've helped. So meet Vikram and Reshma. So these are CFO. The husband is the CFO in this family, and another executive wife as well. So they're both executives and are really good income earners. So for them, investment was never a plan. We chatted. That's when they sort of thought about investing in property. First investment property. They live in Sydney. They've got their own PPOR, principal place of residence, and investing was never an idea, never a plan. But they got introduced to investing through us, and they bought 3 properties literally within a span of 3 months. and already seen a gain of $280,000. So we are already working on their fourth property because they've seen the game, they know how it works. And it is time consuming. It's not like, when you've got properties, you need to spend some time to manage it. So as far as you can take out some time from your calendar every month, it's a great way to increase your wealth, even while you're earning a lot. So IT professional not earning a lot, this a single family income in this case. Again, a couple, but only the husband is working. And they started their journey with us last year. In July, we bought them a property in regional Queensland, which was bought for $427,000, and then another property for $512,000 in January this year, once they were able to extract equity out of this property. So overall, $190,000 grown in 9 months, which I think is pretty solid returns. And they also never thought that they'll be able to build a portfolio because of low income, but they've been able to scale to 2 properties already and are already thinking of their third later down the track this year, hopefully in 2025 and or early 2026, based on how fast their equity grows. A couple of other results as well, and this is again very common and very repeatable results. So this is probably most exceptional, 252,000 made in 7 months. I wouldn't say that that's easily repeatable. That's a duplex, and I think was purchased highly under market value. And if sold separately, can easily be sold for 820 or more actually today. 209,000 in 19 months, again, 40% growth there, which is fantastic. 12 months, 145,000 on the back of 545K. So usually you would see that you would be able to, if you're buying in property in the right location, outperform the market, usually double-digit growth in the first 6 months itself. That's very common from what we've seen across all the properties. We are a 5-star rated agency. We've got about 50 Google reviews from our clients and our partners, and we just love reading each one of them because it makes us feel grateful. So why strategy matters? I think this is probably where we start, sharing some value for you guys here today. And before you get stuck in your journey, because this is something I wish even I knew earlier when I started my journey. I bought one of our properties in trust just about when the borrowing was about to be locked out. But if I would have bought trust properties earlier, would have given me more borrowing even today. So I'm not completely locked out of my borrowing, but this is something that's back on the back of my own learnings as well. So strategic planning is absolutely key. And as soon as you do that, even before starting your portfolio, if you're at 1, 2, 3 properties already, probably the best time to do that now. But if you are starting today, still the best time to do it, because the sooner you do it, the better, situation and plan you would be able to prepare. You don't have to buy the first property in a trust or a company or an SMSF, but good for you to know and make the informed choices. Did you want to add anything else to this, Yuvraj, before we go through the next slides?
I think we can go to the next one. Yeah. We will, adding on as we move along, because there's a lot more to cover.
Yeah.
Yeah.
So if you can borrow $1 million today, right? And if you buy the properties in your personal name, that's it. You have exempted the $1 million borrowing capacity, especially if you're buying a PPOR, all of that is gone. Now, the difference between the right structuring and the wrong structuring is exactly that. So let's say if you can scale the portfolio to $2 million in the same amount of time, or let's say instead of 1 year, 2 years, you can scale that portfolio instead of $1 million to $2 million. The results are starkly different. In 15 years' time, you would literally be about $3 million richer on an average compounding growth of 7% year on year, which is very much possible and has been the case for the last 30 years in Australia. So that number is hugely different, right? So that's why structuring plays a very, very important role to help you scale your portfolio right from the onset. You don't have to scale that within a year. You don't have to scale that, within the first few years, but at least gives you that option. Now, different investment structures that we have when buying property. So obviously there's personal names, so individual ownership. You've got family trusts, unit trusts, SMSFs, and companies. And we'll go through each of the scenarios as we talk through the slides. So the first question that I have for you, Raj, here today is Jason and Min. So these are, they're a couple who are earning about 220K in total, 110K each salary. They already have a home. They don't have an investment. they want to buy an investment property, which their intent is to later on use that as their principal place of residence. What would you recommend them? What entity would you recommend them?
Right. Okay. Thanks. So yeah, that's a very interesting question, right? When you're starting your property journey, you need to again need to know your goals. Like, what are you trying to achieve out of it? Because a lot of times we make emotional decisions in terms of, oh, that's the property I like, I want to buy. And you just generally people tend to buy that in the personal name, which is a very simple, straightforward thing to do, but that's okay. Uh, but if the aim is to acquire more and more assets, there are other options available as well. Because see, once you're going and buying the property into the personal name, sorry, can you move on to the next slide? So yes, of course, there are a lot of advantages because it's very simple. And then, I mean, from a capital gain tax point of view, you will not pay any capital gain tax because you're buying in your individual name. And then even if you rent that property out, you can use the 6-year rule. Basically, that means even if you buy that property, maybe rent it out later on, and if you sell it after 6 years, again, you do not pay any capital gain tax. But now the another thing is, if the plan is, as I said, want to acquire maybe, 5 or 10 assets, then what you should do. The other option available is, even for owner occupied property, you can look into buying into a trust structure as well. Because see, the key question is maximizing your borrowing, right? So if you want to keep on borrowing, keep your borrowing intact, so that is the another way to look and maybe buy your owner occupied property into a trust as well. But again, depending on what you're trying to achieve out of it, we can give you a one-to-one advice which structure works better for you, because there's a lot of variable goes into that. Yeah. Yeah. Okay, we can move on to the next one. So when should you buy in a trust? So yeah, let's take
Yeah,
another.
so another question there for Rich and Sean, and again, they are already at a good, I think, investment journey. They already have 2 investment properties, and they are looking to accelerate their journey and want to buy 3 more investments, but they've only got borrowing for probably 2.
Right. Okay. Yeah. So if you can move on to the next one. So in this situation, like, where you're nearly bottlenecking your borrowing capacity, the best way to do is go for a family trust structure. Yeah. The reason being is because how the bank works is, if you got a, let's say, a borrowing capacity of $500,000 and you go and buy a property in the personal name, then the capacity is gone, crossover, you cannot borrow anymore. That's it. End of story. But now if you want to keep the borrowing intact, we would generally advise client maybe look to buy the property into a family trust. Because how the lending works is, if you buy that in a family trust, then if that trust is self-sufficient, basically it can cover its expenses, you can still keep on borrowing more, because the bank will generally ignore that liability within that family trust. Otherwise, you cannot do that. Apart from that, there's a lot of other benefits of having a property in a family trust is, basically you can split the income. If you're earning rental income, one family member is on, let's say, 47% tax bracket, the other one is on earning a small income, which is 20%. So there's a massive difference between, the tax rate, both of them. So we can even shift the income every year within the family members as well and reduce the overall taxes. And the final thing is, like, when you sell the property, the biggest hit you're going to have is a capital gain tax, right? Structuring right is a massive, massive importance at that time. If you bought it in a family trust, then at least I've got an option to reduce my CGT by shifting the income into family members. Imagine a family of, 4 people, 2 kids, 2 adults. So easily I can divide that income in whatever percentages I want within that family to reduce my capital gain. Yeah. Apart from that, you'll have a asset protection benefit as well. Basically, that means, buying an asset in your personal name, anything goes in your personal life, your asset will always be at risk, right? But if the asset is sitting into a separate structure, which is a family trust, that asset will always be protected from personal risk. If somebody, sued you or whatever, then yeah, you have a good way to protect that asset as well. And finally, if you want to pass on the asset to the next generation while you're still here, it's easy to do that with a family trust, because otherwise you cannot do that. It will have a lot of taxes in terms of stamp duty and other issues in terms of transferring asset to the next generation. Yeah. Yeah, and just a common mistake highlighted there as well. Like, if you already got a property in your name, a lot of people ask us, should I transfer that to the trust? I mean, yes, you can, but again, depending on situation, we need to advise you accordingly. Generally, we do not prefer that. The reason being, you have to pay the stamp duty again if you do transfer your existing asset. So, I mean, if you want to let's say, your borrowing capacity is up here, cannot borrow anymore. Maybe it's time to look into the asset which have already performed, sell them out, and then buy them in a family trust. So you can keep on borrowing. Okay,
I think there's a question, how do we overcome this problem?
sorry, do you want to be a bit specific in terms of what problem we are talking about? Hi, Larry, can you give me the context as well? Yeah, I'll answer once he reply to that. That's fine. We can keep moving soon.
I'll just unmute. Give me a
Yes.
sec.
Now I'm able to talk. Yeah. Hi, Yuvraj. Hi, sir. This
Hi.
is regarding like buying in our own name.
Yes.
Same situation that I'm in now. So how do we still get borrowing capacity?
Right. Okay. So
We are exhausted now.
yeah.
And
Okay. You're right. Okay. So there's new yeah. So there's a recently new thing came in as well. So it's an eye opener for everyone. So let's say you got an owner occupied property, you got a $1 million loan on it, and now you want to buy an investment property, but the problem is you cannot borrow anymore. The solution to that is set up a family trust. Okay. Move the owner occupied loan, not the property, just the loan, towards that family trust. So that ways, your loan is not sitting in your name anymore. It went to a family trust. But remember, you need a good broker's help to do that as well. So once the loan is moved to a family trust, then when you go to the bank again, they will not see any liability sitting under your name, which means you're still able to borrow more. Does that answer your question, Larry? Yeah. Okay, great. Yeah. So let's move on. Yeah,
Okay,
this is a very important aspect. Yeah, and yeah, make sure people, anybody is owning, a multiple homes, borrowing capacity issue, maybe think about moving owner occupied loan to a family trust. So that way, we're not paying any stamp duty because we're not actually moving the asset. We're just moving the loan to a different entity.
one thing, like, do we still pay the double tax stamp duty as you said
No,
before?
no, as I said, you're not moving the asset. So assets
Oh,
remain still in your name.
okay, got
So
it.
if the asset doesn't change the owners, then there are no stamp duty implications.
Yep, makes sense. Thank you.
Yeah, I think
Thanks.
we've got one more question. Can we also move the investment property loan to a family trust? Yes, you can do that as well. Yes, that's not a problem. But see, the only thing is, which is not really clear from the ATO ruling is that if you do that with the investment properties, you might not be able to claim the interest against your property because the loan has moved to investment loan has moved to a different entity now. So which is not a great idea. That's why we generally propose to go for a owner occupied property where generally the interests are not tax claimable.
And how does this work, Yuvraj, in terms of the unlimited borrowing, and how can you just keep going? And why do banks ignore it? One, if you
Right.
know the
Okay.
answer
It's
to
just,
that question.
yeah, I don't know the answer to that. I think we need to involve a banker in there. But I think generally speaking, see, at the end of the day, bank wants to lend money. But on top of that, they need to make sure they are, going with the compliances as well, issued by, the authorities. So they just, need to ensure, if you got an asset within a structure which is self-sufficient, basically that means, that asset does not need any help from you, right? So basically, the bank will ignore that liability while calculating your borrowing capacity. So that's basically how they work on it. But if the asset is in your personal name, they cannot say that it's a self-sufficient because the asset is sitting in your name, not into a separate entity. So that's where the major difference is. Hence, you are able to borrow more.
And what support do we need from the accountant
Right. Okay.
to keep
From
borrowing?
accountant, yeah. Again, depending, you just need a letter from the accountant. That trust is self-sufficient. That it's able to cover its all expenses. Yeah.
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 And does that need to be from the same accountant that the
I
trust
mean,
was set
generally
up with, or
it should be from the same accountant who's generally you working with. But yeah, if your accountant is not helpful, he's not guiding you, advising you, then of course, yeah, maybe it's a good time to review and
just switch?
move to a different accountant who can assist you, guide you, and able to help you as well.
Yeah. Thanks. Yuvraj, I think there's another question. After moving PPOR loan to trust and seeking feature, do we need to pay capital gain tax?
Again, as I said, the asset still remains in your name. It's still an owner occupied asset, so which means no capital gain tax implications.
Perfect. Great.
Yeah.
Thank you. A lot of thumbs up there. Okay. So moving on then, and feel free to ask questions as we move even for family trust. If you've got any questions and you weren't able to ask, just pop that in the chat and or unmute yourself. I'll just enable the unmute feature. How to move PPOR loan to family trust. We'll probably take one more question before we go through the rest. How to move PPOR loan to family trust. Yuvraj, do you know?
Right. Okay. Sorry. That's a question for the mortgage broker, actually. So you need to consult with your broker in terms of, and he will guide you in terms of what needs to be done. And there are only few banks who does that. Not every bank understand or will assist you with this sort of arrangement. But yeah, have a chat with the broker who knows, what's happening, and then they'll be able to assist you.
Because that will open up a lot of borrowing power for people.
Of course. Yeah. Now
All
that's
right.
a very, very important slide as well on here. Yeah, the importance of structure and advice. And this is with the example in terms of, the cost comparison as well. So let's say, Sudha has advised you to buy 5 properties in Queensland, right? So you go and buy all 5 in your name. Well done. You got 5 properties now. But again, on the other hand, you got a big land tax bill as well of $12,750 because all the properties are in your name and you've breached the available threshold. But now compare it to if you're buying those 5 properties in a separate trust. So you got 5 different trusts and you're buying 5 properties within the same trust, same value, nothing changed. The difference is the land tax bill is zero now because each trust is recognized separately for the threshold. So you pay no tax, but to maintain the trust, you have to pay the tax and accounting fee, which is generally around $1,200. So if you look at the total cost comparison, even after paying accounting fee, you're paying only 50% of that cost and everything is tax claimable. So which is even lower depending on your tax brackets. So you see the massive difference, in terms of your ongoing expenses as well. So again, the right structuring is the key because it can help you to save on a lot of other expenses as well down the line. And land tax is one of them. Again, but remember, land tax works very differently in different states. So we need to give you the right advice based on the property you're buying, where you're buying. For example, it may not work in New South Wales because land tax works very differently, but there are another structures you can go with, for example, a unit trust where it can help you to reduce the land taxes if you're buying particularly in NSW. Okay, yeah, we can keep on moving.
100%, I think, Kanka, with you there. Please don't buy in a family trust in New South Wales. Huge tax bill.
Huge tax bill, yeah.
Yeah. All right. So another question now, and probably a good segue into unit trust as you were talking there. So one advantage is obviously, the land tax component that you just explained, Yuvraj. But apart from that, if someone wanted to, instead of using a family trust, what kind of way? Obviously, the answer is unit trust there. But like, what's the best way to distribute profits in different percentages for a trust, especially if they were working with a partner, a friend, or someone unknown, just doing a joint venture?
Yeah, right. Yeah, that's a great question. So if you're trying to do something with a partner, your friend or someone, so unit trust works best in those situations because the investments might differ in terms of you might be investing as the slide shows, 1.5 million, the other person is only contributing 1 million. So there is an unevenness in terms of the investments, and same goes with the outflow as well. So you need to make sure you are getting, your share of the pie in terms of what you've invested. So that's why unit trust works best because you can define your benefits. It's just like a company where your shareholding is defined. So if you want to hold 60 units of that unit trust, so basically 60% benefit will flow towards you and then 40% to the other person. So that's why it works best. It avoid all the uncertainties within that, structure. And the other advantage I've just highlighted, especially if you're buying a property in NSW, and you want to ensure, a lot of people ask me this question as well. What is the benefit of buying, in a unit trust? Because see, the outcomes are fixed. So if husband and wife are buying, like if you buy in a personal name, you'll have the same outcome if you go and buy in a unit trust because the tax point of view, we have to distribute the similar income to both of you, and your proportions are already fixed. So there's no massive difference between, if it's a husband and wife, but the only big thing is the borrowing capacity. Because you're going with the unit trust now and you're buying in New South Wales, you'll save on land taxes, plus you get to keep your borrowing capacity. That's why people go and buy in a unit trust in New South Wales rather than in their personal names. Yeah,
Thanks, Yuvraj. I think there's a question. What happens if I sell the property that's under family trust? Can you expand on that question a bit,
right. Okay.
Navija?
Right, sure. So if you sell a property in a family trust, so the trust does not pay any taxes. So let's take a very simple example. You bought the property for 300K, you sell it after 6, 7 years, whatever. For 600K, you got a capital gain tax of 300K. So now you need to decide based on the trust deed and the available beneficiaries how you want to distribute that income. So whosoever receive that income, if it's going to an individual, they will receive a 50% capital gain tax discount as well. But if it's going to a corporate beneficiary, they will be paying flat 25% tax. So there's a lot of ways you can skin the cat and then you reduce your taxes. Yeah. But you will get that 50% capital gain tax discount with the family trust, which is the most important thing.
Great. Hopefully that answers your question, Navita.
I think there's one more question. Yeah.
Can we extract the profits from unit trust? Means if the property is positively geared, can we extract that money annually?
Yeah, of course you can. Yeah, so that's why people generally set up unit trust in order to, take the funds out in according to their unit holding. So yes, of course, yeah, you can. Yeah, same goes with the family trust as well.
Right. We'll move into the next bit then. SMSF. So Nish is a dentist and he's looking to buy an investment property and potentially rent that out. What shall he do, Yuvraj?
Right. Okay. So yeah. So we are talking about here the SMSF, but before I go into that topic, I want to ask a question on the floor that what sort of returns people are getting with their existing super fund. You just type that in, on average, what you have done in last, let's say, 5 years or 10 years. I'll just give it a 1 minute to get some answers. Yeah, I think that's a broad number, 5 to 10%. Maybe just give us a one number that will make it easier.
9, 5 to
Yeah.
10, 7, 6, 10. Yes, so 7 to 8.
Yeah, I think on average we can say around 7%. Yeah. Yeah, that's about right. Yeah. So if you look at it, I mean, look at your any super fund has performed between 7 to 8% at max, and that remember that's a cash on cash return. And why people go and look into set up SMSF? The reason is the returns can be substantially higher compared to what you're getting, and the only reason because you're using leverage, right? Because you're putting just 20% of your funds and 80% is coming from, the bank. Hence, since you're able to, get a better returns. Again, it depends on how the property is performing as well. If it's a super performing property, then of course the returns will be much higher. But if it's a lower, then yeah, you know the answer. But anyway, let's dig on this topic in terms of the question was raised. So why, again, what's the best strategy? Like, again, if your borrowing capacity is gone, you cannot borrow anymore, but still you need to acquire more asset. What are the other options available in terms of what we spoke about? So SMSF is one of the other, entity which can be utilized to keep on borrowing as well. Because if your personal capacity is gone, you can still borrow within the SMSF. They will not look into what's happening in your personal circumstances. So the bank will still lend you the money. And now the magic is that how the taxes works within super. So it starts with 15, goes to 10, and then the magic number, it goes to 0% as well. So I'll just give you a bit of summary on those numbers as well. Any income goes into your SMSF from your contributions or rental income, that will be taxed at 15%. Now, capital gain tax, it's only flat 10% if you sell the property after 1 year. So imagine, you buy the property for 300K, sold it for $1 million. There's a great gain of 700K sitting there, right? Outside super, you might be end up paying nearly 47% tax on that. If you're already a high earner income or if you're earning a good handsome salary, you're looking to pay around that. But within the super, you're only paying 10%, which is $70,000 only. So massive difference from the capital gain tax point of view. And now if you hold the property till retirement, which is generally 65, and if you sell it after that, imagine paying no taxes at all. That's a 0% capital gain tax. You heard it right. It's a 0%. And even if you hold the property after retirement, any rental income you're going to earn out of that property, that's a tax-free rental income as well. So imagine having 3 more properties within the super, and by the time you retire, let's say they're all loan-free. So if you're earning, let's say on average around maybe maybe $1,500 to $2,000 a week, from those properties, that's all tax-free income coming to you. So which makes a massive difference. And the other thing, like it's especially applicable to people running businesses as well. They can buy a business premises, let's say a warehouse within the SMSF, and then can rent it out to their own company as well, which is not allowed for residential property. Basically, residential, you cannot rent it out to yourself or to a relative or someone, but within a commercial property, you're allowed to do that. So, let's say a dentist is running his business, he want to buy his commercial premises for running his dentistry practice. Yeah, the best thing is go and buy, that, warehouse or office or shop within the super fund, and then pay a rent as well. So you can claim expense as well. And that expense is only getting taxed at 15% within the super. So it's a sort of a double benefit you're generating out of it, Yeah. Right. So we got some questions.
Yeah, a few questions there. Go for it, Yuvraj.
Yeah. So would SMSF borrowing affect my personal borrowing capacity? The answer is no, it will not. If I'm a guarantor on the SMSF, yeah, as I said, yeah, it won't impact your personal borrowing capacity, because when they're looking at the SMSF, they're only looking at the rental income the property will generate in the future, plus the contributions coming into the super. So your personal capacity, even as a guarantor, it's not impacted. That's
So
fine.
it doesn't, yeah, so both ways, it doesn't impact either way. So your SMSF is not impacted by your personal, and personal is not impacted by your SMSF. One thing to note though is, for getting a loan in SMSF, you do need income. So let's say if you decide to take a break of an year and then you want to buy an buy a property in SMSF, in high likelihood, the bank will not give you a loan, or as much loan as it would have given you when you were in a job. So just take that note. If you're planning to have a change of plans, best time to do that, buy that property would be before you change the plans. There is no, yeah, go on.
The other thing I just want to add as well, a lot of people think, oh, I part money into my superannuation, I cannot access it, what will I do? I have to wait for so long. That's okay. So I'll just give a very simple example there. Like, if you got a cash sitting with you of $1 million, what are you going to do with it? You don't want to let it sit in a cash bank account. Maybe you will invest that money. And when you invest that money, you're not going for a small, small investment, like, small period investment, which is 5 years or 10 years. You're going to invest it for the long run anyway, so which means the money is invested, you don't have access it anyway. So why don't we, rather than putting everything into personal name, why don't we go and invest in a best structure available from tax point of view? Basically, it's a tax haven. Put some money in there. Of course, yeah, you have to wait, inside outside, so it doesn't really matter. But at 60, you can start taking money out of your super, not everything, but up to 4 to 10% for the balance. So if you got a balance of 1 million sitting when you're 60 in your super fund, you're allowed to take around 10% of that balance, which is 100K every year till you retire, till 65. After 65, of course, you can take everything out.
Yeah, and see, not a financial advice, but personally, that's what we've done. We bought a property in SMSF, a residential property, but residential or commercial, it's I believe the numbers for us at least worked much better in property compared to what a self-managed super through stocks and or a superannuation fund would have given us. So property prices grow at an average of 6 to 7% year on year, and that's leveraged. And that's why that worked for us. So again, consult a financial planner if you wanted to buy a property in an SMSF. Take that financial advice. But from a numbers perspective, you can run the numbers. There are really good tools out there. moneygov.smart.au, I think, is one of the website which gives you compound interest tools, and you can run the numbers yourself. A lot of people said here's 7 to 9%. Even if you take 9% year on year return on your superannuation fund, which is growing in the super industry super, versus if you were to take a 6% year on year return on a leverage property, you can do the numbers and see which one outperforms.
Yeah, the other thing, so beautifully touched on is, getting the right advisor as well, because SMSF is not a straightforward product. It's a bit complexity involved as well in there as well. So before you, think about maybe getting a property, it's better to get a right financial advice as well, because they can put you onto the right path as well in terms of guiding you on not just the property aspect, but all the aspects of the super fund. Yeah, and we are financial planners as well, so we can assist you in that aspect as well. I think there's few more questions we haven't covered. So, Lara is asking, there's no CGT on SMSF property. Sorry, yeah, there is CGT implication. It's 10% if you sell the asset after 1 year, And if you sell the asset after retirement, is 0% capital gain tax. So yes, there's no CGT if you're selling the property after once you reach the retirement age. The next one is, do I pay tax on rental income if my SMS service property is positively geared? Yes, of course. So if the property is positively geared, you need to pay tax on that rental income, which is 15%.
15%.
But remember, yeah, you're allowed to claim all your expenses, which you are claiming if the property is owned in your personal name as well or in a family trust. So there's no difference in terms of the expenses. Everything is allowed, your depreciation, your interest, your rates, your water charges, your property management fees. So everything is claimable as normal. So if the property is positively geared, you have to pay 15% tax. But if the property is negatively geared, then you're able to offset that negatively geared, income against your contribution income, because generally on contribution, which are coming from either your employer or your contributions, you have to pay 15% tax on that. But if there's amount negatively coming from the property as well, you're able to reduce that taxable income and pay less tax. So basically, you're saving 15% if it's negatively geared.
Yeah, thanks. Yuvraj, one more. Can we invest in stocks ETFs also through SMSF? Say after investment, property investment, some cash is left in SMSF.
Yeah, that's fine. Yeah, see, in terms of the investment assets, you are allowed to buy anything which is increasing in value. For example, ETFs, stocks, mutual funds, gold, or even a land as well. So that's fine. Yeah, if there's a cash sitting there, it's up to you. And other people, I mean, what generally other consensus is, because see, generally the interest rates are a bit higher within the super. So, I mean, if you don't have any other choice, you can even park money in the offset account as well and save a good amount of, interest as well on the loan.
Yeah, consult a good mortgage broker because not a lot of banks offer. First of all, not most banks don't offer SMSF loans, right? So there are only a few, and out of those few, there are only a handful who actually offer offset. So before you go and decide which bank to go with, depending on how much amount you have, if you are planning to park your money in offset, a very good consideration would be to check with your broker before finalizing the bank whether the bank does offer an offset account. Can we transfer investment property in the personal name to SMSF as well, Yuvraj?
Well, yeah, unfortunately, this is not allowed. You're not allowed to do that. Because as I said, ATO and the CIS Regulation Act is very, very, strong. Yeah, you're not allowed to do a lot of things which involve selling your personal asset to the SMSF.
Can the loan be transferred similar to what you were saying about the trust? Can that be done?
No, SMSF you cannot do. Yeah, another thing with the SMSF you need to note as well, as generally with the property either in your personal name or in the family trust, you're allowed to use the equity. If there's equity build up, you're allowed to take that out and put into a next investment property. That's fine. Within the SMSF, this is not allowed, unfortunately. But of course, remember there's a strong reason as well from the government as well, because this is the money for your pension. They don't want you to play with it, and take unnecessary risk. So they want, within the SMSF, they want you to play very safe.
Yeah. Thank you. And another question: for negatively geared IP in family trusts for 7 to 8 years, do those losses count towards CGT calculation when we sell them?
Yeah, okay. So let me give you a clarity on that, how the losses works in a family trust. So see, generally, if the property is owned in your personal name, you're allowed to claim those losses and offset against your PAYG income and reduce your tax payable. But within the trust, it works differently. If there are losses in the trust, you're not allowed to take them out and offset against your PAYG income. You're not allowed to do that. But in saying that, it doesn't mean the losses are lost. You're allowed to carry them forward to the future years. So simple example, you got losses in $5,000 loss in year one, same in year two, same in year three. Now you've got accumulated losses of $15,000, right? In year four, you made income out of your property because let's say interest rate goes down, your rental income goes up. Now the property is into a positive territory and your let's say income is $5,000. So in year four, you do not pay any tax. You're allowed to utilize your losses until you fully exhaust them for the years going forward. So basically the difference, if you look at it, it's only the timing difference. You're not losing anything. With the investment property in personal name, you're allowed to, offset the losses again every year, but within the trust, you're only utilizing them when the property is positively geared, or else, as the question asks, if you sell it, you are allowed to offset those losses against your capital gain tax as well. And remember, it's a good thing to utilize the loss. A lot of people doesn't understand this, to use the losses in the future years. So because see, with time, your income goes up. so are your taxes, right? So you want to utilize the losses at that time when your income is up here, not here. So that ways you'll gain more benefit out of it by using the losses in the future.
Okay, another one there. Thanks. Hi. So Aura has asked that question. Hi, if my borrowing capacity is capped at 400K, does that will be my ceiling when I buy properties in future? Also, if I have say 600K, does it mean if it's lesser value than so it's not an issue? Or must it always be retained with similar value?
Right. Okay. Yeah. A bit confusing here, but anyway, let me read through it again. If my borrowing capacity is capped at 400K, does it mean my ceiling and will be my ceiling when I buy property in the future? Yeah. I mean, yeah, of course. Yeah. If your capacity, sorry, the available borrowing is 400K, the bank, the maximum will give you 400K unless you got a high raise in your income. If your income is, let's say 100K, it goes up to 200K, of course, yeah, the ceiling will go up. You will be able to borrow more.
And usually in trust, from what we have seen, the borrowing is a little bit lower. So just check with your mortgage broker as well as to how much you can borrow in trust. So if you've got personal borrowing of 400K, doesn't mean you might get exactly the same borrowing in a trust. Just double check that with your mortgage broker.
Yeah, the another thing is, within the trust, yeah, rightly said, you will get a bit less compared to what you can borrow in your personal name. But remember, with the trust, you're able to retain that as well. So if you got a capacity of, let's say, 600K and the bank is only giving you maybe, let's say, 525 within a trust, you may think, oh, I'm losing 75K, but not really, because when you go and buy the third property, you'll still be able to utilize that same borrowing capacity again, which is not available if, you bought the property in your personal name.
Yeah, there's another one from Hiral. Yeah, hi guys, if you're purchasing under the trust structure, do we need to wait 12 months to buy another property or show that existing property is self-sufficient before borrowing again?
I mean, yeah, there's no waiting time. You can buy it at any time. But remember, what we generally advise clients is to buy one property, one trust. Because if you start accumulating assets within the same trust, you're exposing the liabilities to the bank. Okay, the lendings works differently here. If you got already an asset sitting in a trust with a $500,000 liability and you go to the bank and say, I want to buy the second one within the same trust, you're exposing them with that you've already got a loan of $500,000. So it will not work in your favor from borrowing point of view. So it's better to go and set up a separate trust. And even after 2 months, you want to buy the second one, so that's fine. You'll still be able to borrow as long as the first trust is self-sufficient. As long as you're able to prove that it is going to keep it, its income to cover its expenses. That's all the bank is after.
Yes, I think similar question. Hey, Vikas. Again, another question from Vikas there. For family trust, can I set up trust after trust one in small amount of time, say 1 month? So I think that's just been answered. Yes, that's possible. When there is not enough time to show self-sufficiency of trust one to get a letter from accountant from trust to loan. So I think there are mechanisms, Yuvraj, how the trust can be self-sufficient, right?
Right. Okay. So basically, I mean, if the trust is only 1 month old, for example, and you only got a 1 month of rental income, then the accountants need to do future projections of the income and expenses, right? So they'll ask you for all the documents in terms of what your interest rates are, what is the loan amount, what are the, general expenses you're paying. And if the property is not yet rented, you can get an appraisal from the real estate agent as well to utilize to work for those cash flow projections. So if the projections works out to be positive, good luck, you're still in good hands. But if it's not, then again speak to accountant and see what can be done, and they maybe help you out. Yeah.
Yeah,
Right.
perfect. And I think answer to your question, Aura, does it always have to be the big banks? Not necessarily. You can go to any banks, and there are a few banks who do offer borrowing interest and some who don't. A lot of banks do, but you don't have to just continue borrowing under with the big banks. How long does it take to set up a trust? Or with Yuvraj, I think it takes a day or two.
Yeah, so that's that's a really interesting one as well. So yeah, as we specialist in the field, right, generally it takes maximum 1 days. In worst case scenarios, maybe 2 or 3 days. That's the worst scenario. But the another thing is we've got a super fast service as well. If you need a trust setup done within 2 hours, we can make that happen as well. Of course, there's a bit of premium you might need to pay, but we can make that happen as well.
Awesome. I think I had a question as well.
So how we can book it? Yeah, you just email me and then I'll sort you out. So basically what I'll do is once you maybe send me your email and then I'll send you what details I need. Once we have it, we'll be able to set it up for you.
Yeah. And how does Yuvraj? I've got a question around like expenses like buyer's agent's fee or stamp duty and whatnot. How are they tax exempted um, in a
Right.
trust?
So, I mean, see, with the expenses, what we do is we need to follow the ATO guidelines in terms what are revenue. So there are only two kind of expenses. Either they are revenue in nature or they are capital in nature, right? So if they're revenue in nature, basically we can claim them every year. But if they are capital in nature, we need to either depreciate them over the period of life, or else we need to add them to the cost base, right? For buyer's agent fee, we have to add it to the cost base. So it's just increasing your cost base. Basically, you will get the benefit of that, but when you sell the property.
When you sell it.
Yeah.
Okay.
Yes.
So
You're not losing
same as
anything.
stamp duty. Yeah.
Yeah, same as stamp duty. Yeah, you're not losing anything, but yeah, you have to hold the property till you sell it. Then yeah, of course, you'll utilize those benefits.
Perfect. For family trust, another question from Vishal. Hey Vishal, are the yearly losses included in CGD calculation during selling?
Yes, the answer is yes. We've already, had a talk on this topic as well. Yeah. So basically, see, you got accumulated losses. Let's say, 10 years, the trust is negatively geared. You build up, let's say, 50,000 losses. So when you sell the property, you made a gain of $500,000. You're able to offset those losses against the capital gain tax. Yes.
So I've got an interesting question on the back of that, Yuvraj.
Yeah.
In individual name, when someone is buying a property and they are claiming tax deductions every year,
Yeah.
would that, so let's say if a property is 10,000 negative,
Yes.
they claim tax deduction and got 4,000 back in
Yeah,
the pocket.
depending on your tax rate, 30%, 40%. Yeah, that's right. Okay.
Just as an example, how does it work at the time of selling? Would this 6,000 negative can still be claimed or deducted from the capital?
No, not
Or
really.
not?
So you see, with the negative geared, you've already claimed all the expenses and you got your tax back at the marginal rate. But remember, when you're going to sell the property, there's a catch as well. You have to add back all the depreciation you have claimed over those period as well. So if you claim, let's say 200K depreciation, that has to be added back to the calculation. So basically what ATO is saying, yes, I've given you a period of grace by letting you to claim all those expenses and giving you tax back. But now please pay me everything back, because the rule says depreciation has to be added back to the tax calculations. So imagine, somebody's on, claiming those benefits at, 30%, but now their income is above 200K. Now they're adding back those depreciation. They're paying tax back to the ATO on the depreciation part at 47%. Right. So that's why we are not really a big fan of negatively geared properties, because I mean, a lot of people think because I'm saving tax, because it's helped me, but not really. First of all, it will impact your borrowing as well. If the property is negatively geared, the bank is going to look at it's a negatively geared property, not helping with the borrowing. And secondly, you're paying tax, when you sell the property. Anyway, yes,
So what do you say? There are no benefits. There are no. Are you saying there are no benefits of depreciation?
I mean, they're of course, yeah, from cash cash flow point of view, yes, there are benefits because you're getting a little bit back in your pocket to help you to sustain the property. But remember, in the long run, you have to pay it back as well. You're just paying the depreciation bit, not everything. The interest and other things, you're not doing anything with them. You've claimed them, you claim the tax deduction, that's fine. But depreciation, you have to add it back, yeah. So, I mean, yeah, you just need to run the numbers and see how it will look like, So basically that will help you to decide, because a lot of people, as you know, so as well, asking you, oh, should I go for a positively geared property, or should I buy a property with a higher capital growth, potential? So that's where the answer lies, what you really want out of the property. If it's like you're looking for a capital growth property, tell me if I'm wrong. Yeah. So you maybe have to compensate with maybe negative, geared property, for example. Yeah.
See, negative gearing is never an outcome that we chase, right? So it's always the capital growth. Unfortunately, in 2025, anyways, the areas that you want to invest in are, if you're investing in an area that's positively geared, most likely that wouldn't have capital growth. So hope that answers your question, Yuvraj.
Yeah. No, that's right. Yeah. I think
Okay, so what sort of services and support can we get? So Aura, I think we can probably have an offline chat if you wanted to engage our buyer's agency. Happy to help you. I'll probably pop my number in there as well if you wanted to reach out. We can have an offline chat. Thank you for asking that. And Vishal, thanks for another question. What are some cost-effective options to transfer a property from personal name to a family trust?
Unfortunately, I mean, that's not a strategy we generally recommend unless, there are reasons to do that. Maybe, let's say, somebody's in a medical profession, they already bought a property, in their personal name. And now because of, the asset protection issues, they want to transfer the property. In those scenarios, it's okay. But remember, stamp duty implication has to be there. They have to pay the stamp duty at the market rate. Plus, they have to pay the capital gain tax as well between the differences between when they bought the property and the time they are transferring it. So never a recommended strategy. It's better to sell it out, realize the capital gain tax and buy a new one within the family trust. That will help you to avoid, that stamp duty issue.
All right, thanks,
There are
Yuvraj.
specific reasons,
Yeah, I think we've gone about 8 minutes over time.
Yeah,
So I'll
yeah.
quickly jump into the next bit. I'll skip this slide. I think we'll talk about companies.
I'm
So
gonna put my
that's
details as well there, like, just in case if anybody
yeah,
want to get in touch, just feel free to. I'm just gonna pop in my number and my email again there. That's fine. Yeah. So yeah, let's quickly cover that last bit as well. The companies, right? Yeah. So ideally they are suitable, like, when you want to do some developments or maybe flipping. The reason why companies are recommended structure, one big thing is when you're doing any sort of development, you need to make sure nobody can come and sue you for anything, any wrongdoing or any, important factor is, that if anything goes wrong, especially with the development, anything can go wrong, and people will always look for ways out to, get compensation from the builder. So that's why company structure will protect you, give you 100% asset protection. Plus, the other thing is you're allowed to keep the profit parked in the company as well. The company's trading entities are only taxed at 25%, right? So if you're already earning high income, 47% tax, what are you going to do? Then it's better to keep the profits parked in the company and utilize those for future products. So that way, you're keeping your tax rate flat at 25%. And when time comes, let's say you retire, then you can start milking the cow. Basically, you can start taking dividends out of the company with the franking credits, which will help you a lot. So basically, you flatted out your tax rate at 25% over the average, period of time.
yeah, and I've seen a lot of flippers using this strategy as well. Renovation projects,
Yeah.
very common strategy to use companies there.
Yeah, the companies do not get CGT discount, but again, you're doing a project, so CGT is not even applicable to those scenarios anyway. When you're developing or doing a flipping project, it's more like a income producing activity, so where income tax is applicable, not the capital gain tax.
Yeah, and it's usually done within weeks
Yeah.
or months. Anyways, you're not waiting for a year to hold it to get the 50% capital gain exemption.
Yeah, and
Okay.
there's just summary table for comparison of all the different structure. Let me just quickly run through the tax rates. For individual, it's up to 47%. SMSF, as I said, between 0% to 15. Family trust is flexible depending on who the beneficiaries are, and the company it's flat at 25%. And again, who the structure are set up, suitable for depending on the situation and what you want to achieve out of it. So companies are good for development, trusts are good for growth assets, SMSF best for retirement, and individual is just, simple and straightforward setup.
Yeah, Larry has asked a question. Why not trust here? Trust also has asset protection. And you can
Yeah,
also
yeah.
park the money in trustee company.
Of course you can, yeah. If you got a trust set up correctly with the corporate trustee, it will have the same asset protection as a company, yeah. But we are talking about developing projects, because you want to have a utilization of your profits as well in a simple structure where you can just leave the profits in the trading entity, simple and straightforward. You can do the same thing with a family trust as well and achieve a similar results, but companies are more suitable. Reason being, when you do projects like these, maybe the major problem people run into is the funds. You want to develop a project for, let's say, $1 million, now you're short of funds. What are you going to do? You might invite your friends, I'm doing this project. Can you help me out? Or you want to be a part of this? Easy to bring them in a company, but not in a family trust.
Yeah, good point.
Yeah.
And people use money partners as well. So not just friends, but money partners as well.
Yeah,
So
yeah.
I think we're right at the end of it. If there are any other questions, please feel free to pop that in and we'll probably take a couple more before we wrap up. But in the meanwhile, if you wanted to get in touch, that's our Calendly link. You can use that. You can join our Facebook community, reach out to me via Facebook